One.
One of the most important parts of this show is coming up with a title. And it's not always easy in these markets, right? You can only say buy the dip or tech rack or, those things we use quite a bit. But Triple D came up with a really good one today. Feeling heavy. No, not feeling groovy. Feeling heavy. Does this market feel heavy to you? Like there's sellers lurking? Few reasons for that. We'll talk about it here in just a few minutes. Got numbers at 8:15, 8:30. We got a merger blocked. We got a merger maybe getting blocked. And we have Ryan Detrick at 8:35. Now you know why you wake up early to listen to Pre-Market Prep.
Welcome to Benzinga's Pre-Market Prep.
This is a volatile puppy here.
It's all about execution styles and strategies.
All right, good morning, traders and investors. Boy, choppy overnight session, just like yesterday. That result is we're down four handles at 55.26. The buck down 23 cents, 2-day losing streak after 4-day winning streak. TLT down 21 cents ahead of some key data today and tomorrow. Crude under 70 bucks, up 37 cents though at 69.57. Gold up nearly 20 bucks, 25.46. Silver, that's up 44 cents right at 29, and Bitcoin under pressure again. The futures are down about 1600 bucks at 56,800. Let's bring in simultaneously triple D and AB. And how are you guys on this Thursday morning?
Feeling, I don't know. This is such a weird market here. I'm trying to decide how I feel today. Part of me feels like, oh, I want to come in here and buy some stocks. And then part of me says, are you nuts? Look at this tape. Look at what's happening here. Look at where, the leaders are doing. Such a weird market. Such a weird market. AB, how are you feeling today?
I'm feeling better. I think
Healthy
whatever
wise.
cold, whatever I had is going away finally. Knock on wood. So,
Well, that's good news.
yeah, at least we got some good news. But lot to talk about this morning, and as you mentioned, Joel, we do have Ryan Detrick coming on at 8:35. One of our favorite guests here on Pre-Market Prep. I think let's just start with NVIDIA real quick because that's the
Sure.
biggest stock in the market. So it's got to be some of the biggest news in the market. The other day we covered, of course, the 10% decline and then a subpoena from the DOJ. Now NVIDIA is coming out and saying there was no subpoena from the DOJ. So that was Bloomberg that reported that. Not sure what happened there. But surprisingly, not a rally after the
No.
company comes out and denies that claim.
No, and we saw the same thing happen with SMCI because SMCI came out, talked about, the obviously not filing on time and the short seller report. And they basically, said that they were just checking internal controls and they didn't anticipate doing any changes to numbers. So you would think, that would have a significant rally as well because it sold off 100 points, when they didn't file. So on time. So no rally. Like it rallied like $10 and then gave it all back. It's back down at the lows. NVIDIA, same story, where they come out last night, breaks that, no, we haven't been subpoenaed by the DOJ. What are you talking about? You'd think the stock would get a lot of its losses back because that's why it sold off. No, stock is red. So this is why I say feeling heavy. The leaders are not leading when in fact they are leading. They're now leading on the downside.
They are leading.
And that's the issue that I have here. Microsoft, we talked about this a lot yesterday. We tried to rally multiple times. Microsoft tried to rally multiple times yesterday. Now starting to roll over and trying to get down to the lows of yesterday. 406 is where it's trading this morning. It just feels like the tech leaders are now turning into the tech laggards. And that's an issue for the market.
I would say maybe they left out yet, and like we haven't received a subpoena yet. You know, like,
That's
well,
an important word.
I don't know. We say a lot of things about, stocks, not going down on bad news or not going up on good news. I mean, this is just an absolutely horrible reaction. If I was on the stock saying, "Oh, that's a bunch of baloney, that there's no DOJ investigation, I'm buying the daylights out of this because they're going to come out and deny it. There's nothing going on." The stock should be up 5, 6, $7. It's down 51 cents. So I don't get it. Very disappointing if you're an NVIDIA shareholder with your action. Yesterday's low, 104.12. That's the line in the sand. I think there was another daily. Yeah, there was another daily low right at 103.50. There's your major level, but there's only one low at that level. So I don't know. Puzzling news. You said SMCI, the same thing. It's just people are trapped. They're trapped in the stock. There's so many people trapped from earnings. I don't want to call anybody out in the chat, but someone said, yeah, I caught holding the bag from earnings, but I'm just holding on. And I think that's the mentality that you have. SMCI, NVIDIA, Microsoft. I mean, a lot of these, yeah, it will come back. The market always comes back. I'll break even on the trade.
Well, I mean, that is always, people invest in good companies with reasonable valuations. They usually do come back, unless it's Intel or Cisco or General Electric from 2000. Yes, go back and look at your charts. GE is not at all-time highs, not even close to where it was in 2000. So Citigroup, these were pretty big companies. So that is a fallacy that to think that stocks always come back. The S&P has always come back, but individual leaders have not. I mean, you don't back on that chart to GE, Joel, because you're only going to 2008 and you're like,
I changed it.
You changed
2008, it was over 200. What are you thinking about the early 2000s?
Yeah, you want to know where GE was in 2000? I'll go back. My charts will go back all the way.
1,000?
200 and not 1,000. I have a high in the year 2000. I'm just ballparking from the chart. $285. So here you're 24 years later, and GE at this point in time was right near. It might have been the most valuable company in the world. Did GE ever get that title, Joel?
It was number one. Heck yeah, Dennis. When we were in the office.
With Welch.
Yes.
It was number one. When
I think ExxonMobil was 2. They battled it out for a while.
So you bought the most valuable company in the world, in $285 in 2001, and said, well, stocks always come back. Well, here you are, 25 years later, 24 years later, and the stock is still down 40% from the all-time high, and all you hear about on CNBC is how good of a stock GE is, because in the last few years, it's been going up. It's been a terrible investment. So they don't always come back. You've got to buy good companies at reasonable valuations. You don't pay 70 times. GE, people were paying 70 times earnings for it back then. You got to, and this might bring us into the Celsius conversation, because you got to know what you're buying. And you can pay 70 times earnings if the growth is going to go exponential, a la Tesla. But you can't pay 70 times earnings for, the most valuable company in the world when the growth rate just doesn't justify it. So let's go Celsius here for a second and just talk about its disaster yesterday, because this was an epic disaster. Spinner, talking CELH, obviously, was saying, and Spinner, you said they had some conference or something. They were presenting at some conference or something yesterday. Anyways, obviously didn't go well. Stock fell another 10% yesterday. Just another 10%. Just to continue punish everybody who's been trying to call a bottom on this forever. $98.84, the high in May. The stock is $32. Back in, May, people were paying 90 times earnings, I think it was. 90 times earnings for a company that makes drinks. Not an AI company, a company that makes beverages. Never pay 90 times earnings for a company that makes beverages. This is why the stock has fallen off substantially, because when that growth rate starts to slow, and it inevitably will, you get punished severely. So now we're 36 times earnings still. I looked at Celsius yesterday. Still trading 36 times earnings. It's probably still your most expensive beverage maker out there, right near the top. What's the monster? What's the monster PE? Because that's your comp. Monster PE, MNST, best of breed, trades 24 times forward earnings. So it's still trading with a 50% premium to monster after falling 65%. This is where you got to have your fundamental hat on, combine the fundamentals with the technicals. Celsius, and we've been talking about this stock negatively all the way down. People asking me why, they were saying maybe it's a takeover candidate. It's not a takeover candidate. You know why? It's a trade 36 times earnings. At 15 times earnings, gets attractive. At 15 times earnings, the stock is $12. So I don't know if it's going straight there. There's still maybe some growth, maybe some story. And maybe, at this point in time, you could probably take a flyer, but everybody's been trying to take flyers all the way down. Point is, you got to do the combo approach. You got to have, and again, you got to have a hell of a story. But 32 times earnings for a beverage stock, not for me.
You know what? Spinner just made a good point on the General Electric. Because they had, if you had one share of GE, or let's see, each holder of GE common stock received one share of GE Healthcare on the spinoff in December of 2022.
There was some spinoffs in there, yes. There was some spinoffs, but you can add all that stuff up. I still don't think you get your money back.
Or it's
you can add up
close.
all the spinoffs. I don't know if it worked that way though. Because sometimes in the spinoffs they both adjust. So we'd have to go back and see.
Yeah,
remember Intel spinoff, Joel? Remember Intel spinoff? We didn't get a freaking Mobileye. Now again, you did get those shares, so it does work differently. But we can add up all that, Spinner. The point being is that GE has not been a good investment, and it was the most valuable company in the world back in 2001. You can add all that stuff up. You're not getting the risk-free rate. You're probably down significantly. You can add up all the dividends. People always argue me, well, the dividends, though, you're getting dividends all this time. I mean, think about what the market has done since 2001 and think about where we are now. And you're on a stock that is in all likelihood you've lost money on. Even if you add up all the spinoffs and the dividends, maybe you're flat. What is the opportunity cost? Where was the S&P in 2001, Joel? Where was the S&P? 1,000.
Yeah,
I think it was 1,000.
It went down to, I can't remember that.
So the average stock, in the S&P is up five times in that period. Your G's done nothing. So there's no doubt to say that G has been a very poor investment in the last 20 years. Adding up all the spinoffs and everything, somebody can go do the exercise. It's been a very bad investment. AT&T, same thing. It's been a very bad investment. They give you some spinoffs. Yeah, you got AT&T Wireless came out of there, and this came out of there, and that came out of there. It's been a very, very bad investment. Lucent Technologies, it came out of there, and it went to zero on you. So AT&T, they spun off Lucent, but the Lucent went to zero. AT&T Wireless went off the board, I think it's $6. They're just like the maker of bad companies, AT&T. But that's a whole nother story. Wow. Just saying, you can't just blindly think that every single stock eventually comes back, because they do not. AIG, Citigroup, a lot of the banks, we know JP Morgan came back. We know Amazon came back. We know for every Amazon, there was a million pets.com companies too. So the indexes now are a different story because they always clean themselves up, which is good. S&P gets rid of the trash, brings in the good stuff. The Dow, which is going to get rid of Intel, folks, it's going. It's going to go out. No doubt about it. Zero doubt
Dennis,
about it.
We got ADP at 8:15. We're moving. You're getting pepped. Because we weren't going to go on tangents, and we just gone on a 13-minute tangent.
Because this is where we learn, folks. This is how you learn. It's the tangents that teach you. It's the tangents that teach you. This is how you learn.
All right, still waiting for those ADP numbers. All right, here we go. ADP non-farm employment change for August, 99,000 versus 144,000 estimate, 111,000 prior. So light. It was a light ADP. So that's the private payroll report for August. Of course, we do get some more labor data tomorrow that the market will care more about. But Joel, what's the reaction off this number?
We were tailing off into it. We sold off just a couple handles, not a huge reaction. We also have, I believe at 8:30, we also have initial continuing jobless claims. So we've been choppy all night. I think what our investors need to focus on today is, and it's not a Globex low, but the intraday low from yesterday and Tuesday's low match right there at 55.15. So that's my key level. As long as that holds support, we can we're still going up. We're still going back to all-time highs. But as we said in the show, feeling kind of heavy. So we'll see what those 8:30
Yeah.
numbers
So
give
we
us.
started with that, and back to the leaders because the ADP looks like a nothing burger here. NVIDIA trying to rally yesterday, tried to
Yeah.
rally a little bit on the DOJ news, and just more sellers coming in. It's just overbought, folks. Is NVIDIA, GE, and never coming back to the $140? I don't think so. I think there's such an AI story here yet. I think we're in the early innings. I think valuation is high, but it's not gotten the growth has just justified that valuation. So I don't think it's over for NVIDIA. I'm going to buy more NVIDIA here eventually. I was saying maybe back at 91, I might reload some of the stock I sold at 130. Maybe. We'll see. But at this point in time, it's like, you're in September 5th. You're coming in, you're still in the seasonally weak month. You're seeing, just every time we rally, we feel like we get met with more sellers, not just in NVIDIA. And this is all over the course of the last few days, but the Qs have really been going down for the better part of 2 weeks, Joel. Let's call it what it is.
They turned.
We had the early first. August rally, and we've had weakness here for 2 weeks. 2 weeks. This isn't a 2-day phenomenon. S&Ps, yes, held up by financials, industrials, and Berkshire Hathaway. But move away from that. Tech has been quietly leaking here for 2 weeks now. So it's been a significant come down, fall off here, fall from grace for a lot of tech companies here. Do we come in and buy the dip on day one? I think what you want to see stabilization. I don't think we've seen it yet here. Like, what are you looking to buy? Like, we were trying to talk with you guys.
Yeah, you were saying that yesterday, and I'm like, I'm not looking to buy anything. You got a quad wedge coming up. You have the election coming up. The market's always is already up nicely on the year. I don't know, maybe start thinking about some year-end tax selling. I know it's a little bit early. The institutions do it early, but there's nothing right here, right now, jumping out is saying it's a screaming buy. Maybe a couple individual stocks will get some news and we'll go, but right now, what are you leaning on? You're going to lean on that low from yesterday? That's just what I'm looking at. And so when you were like, what to buy, and that's like CNBC and that's like Twitter, what to buy. Every time the market goes down, what to buy. Well, sometimes you don't need to buy. You need to just sit back.
Did you? Yeah. But again, you're acting like I was trying to tell people to buy the dip. I was asking question. And what was my answer, Joel? What was my answer?
You didn't like anything. Yeah.
I didn't like anything. So I answered my own question because what I was saying was yesterday was everybody was asking me in my social media, what am I buying? What am I buying? What am I buying? And I said, I analyzed, I sat there for 2 hours looking and I analyzed and I decided, no, I just don't see that much attractive here right now. So what I did buy, and I said this to the responders too, is I did buy more Tesla. That's the one thing that I did buy 2 days ago was I bought a little bit more Tesla again. It's the biggest position in my long-term portfolio. I made a little bit bigger a couple days ago because the chart is actually showing a hell of a lot of relative strength. So this was more of a technical thing where I'm seeing a lot of tech really getting hit hard. Tech like getting sold across the board. And every time Tesla's dipping like a buck, it's like buyers are back up and buyers are back up. And you could see it yesterday and you see it again here this morning. And it's a segue into there's news. There's a lot of news here today on Tesla again from a positive perspective. Again, is it Elon Musk with aggressive timelines? Maybe, but he's talking about FSD in Europe and China in the first quarter. So like 6 months from now, 5 months from now. He's launched the ASS. He's always funny, that new summon feature there, which looked pretty cool. I saw a video of it. Just a lot of cool things. They're just working on so much. There's so much cool stuff coming from Tesla all the time.
Tesla pretty strong the past couple of days.
That's why I bought more, AB. I was just saying it. The relative strength in Tesla has been phenomenal. I like looking at relative strength. I love seeing the market go down and a tech stock holding up well or actually going green. It was not a great day for the stocks yesterday. It wasn't a great day the day before. Yet Tesla in those same 2 days is up.
But
so it's telling you good relative strength right now.
But could that also be because, not all because, but part of it is that Tesla has already had this kind of correction or drawdown compared to the other Mag 7 stocks, which are still trading close to our all-time highs, whereas Tesla has kind of come down, and you saw that kind of, I guess, the multiples contract a little bit on Tesla earlier, and then now you're starting to see that in NVIDIA and some of the other stocks.
Joel, address that question.
Could you give it to me again? I was looking at the
Like,
Tesla
okay,
chart
so
there.
we're very distracted too here, AB, because this
I know.
tech market is really getting hit hard here right now.
Yeah, I mean, this
Yeah.
market is coming
Like
up.
I'm like looking at, I have some stocks in
I
my day
know.
trading
I'm just
portfolio,
trying
and I'm
to
like, oh my
adjust this for
God.
things. Okay,
So-
let me refocus. Let
So
me
if
take my
you're if you're an investor and you were looking to go out and buy some tech stocks right now, or buy the dip, and you're looking at the landscape, and you see Tesla is already kind of drawn down, from its highs, versus buying an NVIDIA or Meta or Apple at all-time highs, looking at Tesla, which has already kind of had this contraction in its multiples and valuation, might be a little bit more attractive, or I don't know. I mean, that would be something that I would think.
Okay, I got it. I got a quick answer. Dennis has almost talked me into this Tesla. Okay. But I just don't like the overall market, and I just think that that would keep me out. Like I'm not prepared to start buying Tesla at 220 and then buying more at 200 and then buying more at 180. What I would do is I would try and wait for like a particular area or a particular level or something, and just take a lump, and take it in and then forget about it. I just can't, what Dennis does with that, and in and out and in and out. It's just really hard for me to do. So right now, yeah, I was thinking of saying that yesterday, but I'm like, I don't know. I mean, it just going to the SP. We're just in so no man's land here, with so big information coming up. Jobs tomorrow, inflation data next week, quad witch expiration third week in September, election in November. I mean, so I hope that's a long-winded answer to your question, but yeah, that
And the
is
valuation is not attractive at all.
true.
On Tesla. If you look at the PE, you scratch your head and say it's trading 68 times forward earnings. Why, Denny? You talk about value investing all the time. This is what I get on Twitter all the time. People reaching out. Why in the hell would you buy Tesla at 70 times earnings? You just got done telling us you laughed at the people buying GE at 70 times earnings. And you laughed at, the people buying Celsius at 90 times earnings. And you know what? I've bought into this story, but I believe the earnings growth is going to be astronomical here. I think looking at it, because right now that 68 PE values Tesla as a car company, and that is it. They're getting no revenue, basically no revenue from FSD yet. It's going to start very soon. No revenue from humanoids, no revenue from their energy business, maybe a little touch into it, but it's so early in all these businesses. It's like they're like a startup. You're buying a car company at 68 times earnings, and you have a startup on all of these AI products. That makes sense. And I mean, I can go on a Tesla rant here. I've been tweeting some stuff out this morning, but the stuff they're working on.
Do you think that FSD is going to be better for the consumer? Like they're not going to have to buy cars, and they're not going to have to have
it's a great
insurance?
point you're just making, Joel. And the article that I just tweeted, I just tweeted it this morning. If you get a chance, go and read it. It's from Phil Beazle. Sorry if I'm saying his name wrong. And Phil, if you look at his background, it's on Twitter. I'm assuming it's correct. Was the Rivian tech team. He worked at Apple, and then he was a Rivian tech team founder. And now he's obviously not working there. But he tweeted out the magic of Tesla FSD. And it's a long read. It's a 20-minute read. But when you read it, there's so many cool things in there. And what you were just asking was, are people going to need less cars? He addresses this in there too. And the answer is absolutely. Sees people just using the Tesla robotaxi system and not buying cars. It's just, and maybe this is a reason why Ford trades 6 times earnings and GM trades 10 times earnings. People may buy less cars in the future. If everything's going to be fully automated, you're going to need less cars. You just press your button and Tesla taxi shows up. Tesla robotaxi shows up. And maybe it's not Tesla that solves it. Maybe it's somebody else. But I think the whole dynamic of driving is going to change. Like where we are today to where we're going to be in 5 years, the whole aspect of driving is going to be completely different. whether it's, you know, you believe it's Tesla solves it, or Google solves it, or GM Cruise solves it, or China solves it, you know, that take all that regardless. I think it's going to be Tesla, but I might be wrong. Maybe it's somebody else, and maybe Tesla, you know, stock goes way down. They don't solve FSD, it's going to go way down. I think they do solve it though. It's just going to be so different. The landscape's going to be so different. You're not going to like have to go buy who the hell wants to buy $100,000 pickup right now? Who the hell wants to buy, you know, a $50,000, $60,000 car? The cars have went up
who's the
so
biggest
much.
car insurer right now? Who's the biggest car insurer?
You're still going to need car insurance though, because you're still going to have cars on the road, but it's just going to be maybe less cars. So yeah, so maybe there's a Geico, probably private. Warren Buffett. Private. They're not that priced in because Berkshire Hathaway goes up every day. Maybe that's a segue into it.
Okay.
Lots to think about. There's so much to unpackage here. But read that article that I retweeted, because it talks about why they're not using LiDAR, why they're, you know, focused on the camera system, how the Tesla system is a learning system, how it's actually trying to understand. The cars are trying to understand, as opposed to just like feeding it information and like a roadmap, you know, and like, okay, well, we know, you know, in San Francisco with Google driving their Waymo, the stop sign's at this point, so it knows it. But when you take it out of there, it doesn't know if that's a stop sign. Well, the Tesla vehicle is using Neuralink and trying to understand, no, that's a stop sign. I've seen that before. So it's fascinating to read that, you know, the Google one's just following around on a map. It knows that stop sign's a stop sign because it's on the same basically track. It's basically on tracks in San Francisco. And that's how it's operating. The Tesla has no track because they're trying to do it everywhere. So what they're trying to do is use AI to say, hey, this is a stop sign. And it's like, is it a stop sign? You know, I've got to have, you know, evidence that it's a stop sign. And then, you know, the evidence builds and obviously you see it. You know, the stop sign's faded. Doesn't look very, you know, we know as a human being it's a stop sign, but if it looks a little bit different, maybe the computer doesn't understand. It's trying to get an understanding of that. So it's just completely different. So it's fascinating. It's very fascinating. I think the story is going to just start to get hot. I think the Tesla story is just starting.
Okay. Wow. Wow. All right. Do we got time? We'll talk about X real quick before the 8:30 numbers.
Yeah, let's do it.
Oh.
Well, so X, we have we had the headline the other day that Kamala Harris. So here's the thing: is we talk about some election stocks. With X, you have Kamala Harris, who came out and said she opposed the sale to Nippon Steel. Donald Trump has come out and said he opposed the sale to Nippon Steel. The current president, Biden, said he opposed it. And now the deal is looking like it might not go through here. So Biden administration reportedly warned Nippon Steel $14.9 billion acquisition of U.S. Steel poses national security risks. So it sounds like, did the government officially come in and say they were going to shut down the deal if they tried to? Oh, yeah, Biden gears up to block. So it sounds like it's not official, but that everything is leaning toward the government coming in and nixing this deal once and for all.
We have more numbers here at 8:32, so we're
yep,
going to cover this here in a second, but we're back to numbers again.
Okay, so we took out that low, nice little head fake at 15, back above 15, bouncing around, trying to rally. We are rallying, so we took out that low. Wow, what a chop!
Initial jobless claims 200.
We're green now.
Initial jobless claims 227,000 versus 231,000. So that was actually lighter than expected. Non-farm productivity came in at 2.5% versus 2.3% expected. Unit labor costs for the U.S. came in at 0.4% versus 0.9% estimated, 4% prior. Continuing jobless claims, you're at 1.838 million versus 1.87 million estimate. So that came in lighter than expected. So as much data that we've gotten that the labor market is cooling, the jobless claims this morning actually coming in lighter than expected. So a little bit of a mixed bag this morning.
Data all over the place. It's a tough market, man. Tough day trading market. I mean, price all over the place, you know. And I've been saying, like, the last half of August was tough. Like, it's just got, you know, like chop and chop and chop. And that's tough, you know, when you don't have trends like intraday trending, overnight trending. You know, it's the forgetful market, random walk in the last couple of weeks. And even though we're leaking here a little bit overall, it hasn't been an easy short either, Joel. I mean, this has not been like, oh yeah, stocks.
Just on Tuesday, and it kind of you had to react to it. That was it. Tuesday, and there was a wild session on Sunday and Monday. Tuesday was a trend down day, but yesterday we rallied 45 handles and we got back above last week's low. Then we came down and made a new low of the day. So a lot of indecision. And as you just, we talked about the show feeling heavy for 1 nanosecond. The S&Ps went green. And before I could even look at it to think of trying to sell
the rally.
Yeah, and it was like, okay, so why did you have your order out there? I mean, it went green for a nanosecond, and then like, sell.
All right, we do
keep going. I've got a million positions. I'm going to the back.
Yeah, go ahead. Yeah, then we got Ryan Detrick coming on. Let's go. We had a lot of news.
So let's go back to X real quick. Did you give the technicals on X?
I mean, the technicals, I'd have to go back and look from where it was in the, before this whole deal started, and then it's the 23 to 25 area. Now what you're going to hear in X, and, we've talked about this strategy before, when a stock is, in play, and then something happens, and then it doesn't go through, and then it comes back down to that area. Maybe someone wasn't Cleveland Cliffs a bidder, but I don't think Cleveland Cliffs is it's been falling off a cliff. I don't think they're looking at to do a deal right now. And the other thing too, the other thing that was so puzzling about this whole X deal, and I haven't looked at their earnings lately, but it was just so inconsistent, losing $5. It's cyclical. Losing $5, making $3. I mean, just never consistent. So I don't know why the hell they wanted to buy the company in the first place. But so I mean, if you're banking on something like that, but once again, you're saying, okay, well, someone didn't want to pay 38 for it. Someone said they were going to pay 50, and now no one wants it. Could you just go back to? I say if it got back to the $23, $25 area, that's where it was before. Here, if you're stepping out, but you're going to need someone else to step up to the plate. And I think the other one was Cleveland Cliffs. And I mean, just where their stock is, if we're going into a recession, do we need more steel? I don't know. It's out there. Hands off. Was more confident selling it ahead of the deal not going through than I am saying, okay, someone else is going to come in and scoop this up. It just doesn't feel like the same kind of scenario right now.
Well, I don't have any steel, Joel, but I came across some copper piping over the weekend. So if you know anyone that might want to buy some copper, let me know, and I might have some extra. All right, we see Ryan Detrick hanging out backstage, our stat man from the Carson group. We love bringing Ryan on. Let's go ahead and bring Ryan on a minute early this morning. Got a lot to digest, different economic numbers tomorrow. Of course, more jobs data on the way. What a time to bring Ryan on, because the market just seems so like there's so much uncertainty right now. And if there's one thing I know about Ryan is he'll have some stats for us. So let's go ahead and give Ryan our special intro and see what he's been watching. All right, Mr. Detrick, how are you doing this morning? Welcome back to PreMarket Prep.
Good morning. Happy September. Can you believe it? It's like we're getting older when you say, can you believe what month it is? It's true. But,
can you believe what year it is?
What year is it? I don't even know anymore.
Isn't this year going by so fast?
Yeah.
Was Green Day talking about the stock market when they said "Wake me up when September ends"?
Yeah, that's the joke, isn't it? Yeah, I think they may be after the first day. I mean, we're doing a little better. I saw initial claims just came in, kind of a little bit better, so some calming. But I think that's the case. I mean, I've got like a bunch of slides. You guys just want me to just jump in? I mean, how do I do this?
Of course, man. That's why we pay you the big money.
Well, is it check in the mail? I don't remember. Let's see.
It's all Bitcoin.
Well, I was in charge of sending it out, so
That's fine. Let me see here. Here we go.
Gotcha. Got lost in my bank account.
Boom. You should see that. You guys good?
Yes, sir.
Perfect. So, but my buddy Frank Capillari did this chart. I thought it kind of summed it up. I mean, I'll get into Monday, kind of the big drop in September and the Green Day, go away in September. But let's just put things in perspective. Oh, this cool chart from Frank. We just had over a 10% uninterrupted rally virtually off of those lows, early August until just recently. So one could say, well, maybe we were just due for a bad day. Well, we had a bad day. We had a bad day. And it's interesting because Monday was the bad day. But even the best years see a couple bad days. So I'm looking at 2% drops. Okay. You got to have a cutoff somewhere. Your average year sees 6 of them. Now, let's be very clear. No such thing as average in this world, right? It's my old statistician joke. Put his head in a bucket of ice, feet in the oven, and said, "How do you feel?" He goes, "Well, on average, I feel pretty good." That's the only joke you'll get, I promise. But
that's a new one.
Yeah, it's an
write
oldie
that
but a
one
goodie.
down.
Yeah, it's I've used it once or twice. But nonetheless, we've had 3 2% drops. You can see here, some years have a whole bunch, but usually your best years do not have many. But still, just put some context around the fact that, hey, we're up, I think, 14 or 15% on the S&P for the year. We're close to 20, this time on Friday, but then obviously Monday had something to do about that. But let's talk about Monday for a second. So again, over 2% drop on the S&P. We know a lot of it was NVDA was down 9%. Tech did really poorly. Semiconductors, I think they're down 5 or 6%. One of the worst days they've seen in a long time. But what got us, I might have talked with you last month about this when we had all that volatility in August, was the action we saw in the U.S. dollar. The U.S. dollar on Monday was up 10 bips, all right, 10 basis points. If it was a true risk-off scenario, if it was a true end of the world is coming, like they keep telling us about, we would have expected the dollar to get more of a bid. It didn't. And then really incredibly to me it has been the last 2 days, the action in high-yield corporate bonds. It's on the right there. High-yield corporate bonds are higher than they were on Friday, okay? They had a good day yesterday. They were down only 30 basis points or so on Monday. Again, these are just little clues. It doesn't mean we can't have continued weakness in September, can't have continued volatility. But these are things we're watching in August when we had all the scary stuff happen in August. Sonu Varghese, really smart guy, worked with on our team, was like, look at the dollar. The dollar has been weakening. The Mexican peso was strong during that sell-off last August. Do you think that's consistent with kind of an end of the world scenario? We would say no, right? So we're following these things. And so far, this looks like your typical pre-election jitters, your September jitters, whatever you want to call it. Nothing out of the ordinary. Let's be very clear. Also, the S&P, everybody, has only been, this is interesting, I think, only been down 1 month this year. It was in April, historically the best month. So that kind of spins things on its head. But the S&P has been higher 9 of the last 10 months. And now here we are coming into September. Maybe we are due for a break. I mean, that's not the end of the world, but the action we're seeing in the credit markets and with the U.S. dollar to us again suggests any weakness will be fairly contained. Let's call it 5 to 8% probably at the most, and probably a buying opportunity for eventual new highs later this year. This is kind of cool. When you have a bad first day of a month like we just did, down 2%.
Wow.
The rest of the month, so that's not the full month, let me be clear. So that's starting on day 2. The rest of the month has been higher the last 13 times. I don't know. I don't make it up. It is what it is. Now, here's something for everybody. The 2 worst rest of the months ever after a bad first day were, take a guess, September. It's 74 and 2002. You can see I kind of bolded those where the wheels fell off. So you got something for everybody. But just be aware that a bad first day, just simply by itself, the last 13 times we have seen higher markets. I shared this with you probably the last couple times. Bad stuff happens, right? I'm not a trader. I'm an investor. I'm a strategist at an RIA that manages a lot of money for a lot of investors. Just bad things happen. Scary headlines happen. Bad days happen, even in your best years. Just important to remember that. Were there any clues? I mean, this is one I've dusted off. I'm sure I shared it with you before. When you're up 20% a pre-election year, the election year's never been lower. Sure, maybe you could argue relatively small sample size. I get it, but that's still something that I think was there. Also, I took a look when you're down in a midterm year like we were in 2022. All right. The last 17 times you had an election year or a pre-election year, that's again after you're down in a midterm year like we just were, you're higher. 17 the last 17 times in a pre-election or election year, you're higher after a down midterm year. So just something to think about there. And this is what I share with you. I know a lot. Summer rallies are perfectly normal, perfectly consistent with what you see in an election year. We've said a while. I came on saying don't sell in May, go away. Buy this May, or at least buy this summer. Let me put it that way. And you can see here the best 3 months on average are June, July, and August in an election year, up almost 7.3%. Take a wild guess what we just gained the last 3 months: 7.1%. 3% higher every single month. Now I know, okay, well, barely in some of those cases, but nonetheless, higher 3 months in a row. Actually, or higher 4 months in a row, but higher during those 3 months. So once again, things played out. But then we are coming into, did anyone hear this yet? September is not that great. Yes, it's true. The last 10 years, only month that's down on average. Last 20 years, it is the worst month since 1950. It is the worst month. I call this it is what it is. There's a lot of reasons and people guessing why. I don't know. I could throw out the same reasons. I just know September can be that banana peel month. So let's just be aware of that. But then take a note how strong, November and December tend to be, especially election years, which is this chart. And people worry about September, sure, but just be aware October is the worst month on average in an election year. So I've come on with you for a long time. Say we are bullish. We still think stocks go higher. I'm still in that camp. But what we've done actually, I think I came with you last time. We actually added some treasuries. We had high yield for a good amount of time, which really worked well in the fixed income world. Maybe almost 3 months ago now, when everyone was talking about rate hikes. Remember that? People were actually talking about rate hikes 3 months ago. We added some treasuries because we thought inflation was going to come back and we expected bonds to do much better. So that's worked out. But then you fast forward where we are right now, just 2 weeks ago or so, when we had that bounce, or maybe last week, we had the bounce back to new highs. We added some low volatility ETFs, because how do you do better in a high volatility world? You go low volatility. Not a recommendation, but like SPLV. If you look there, we know there's some defensive stuff in there. What surprised us a little bit, but then when you look into it, there's a good amount of industrials and financials in some of these low vol instruments that are out there. Those are our two favorite groups. We've liked financials all year. I mean, banks, just yesterday, some banks are at an all-time high. So that's been working. So that's kind of where we're still overweight equities, yes, but we are kind of switching things around a little bit in the money we run, expecting potentially your standard September, October volatility. And then we're already talking on our team right now. If we get a 6, 7, 8% correction, what are we going to do? We're going to go back into some of these risk assets. We don't think we're quite there yet, but just be aware of that. Also be aware the second half of September is when the trouble tends to come. And it's funny. It's funny. September 19th is when you peak. Okay, that's my son's birthday. That's the only reason I remember this. But September 19th is also Talk Like a Pirate Day, matey. So when we start to see the weakness, it'll be Talk Like a Pirate Day, just goofy stuff, but easy to remember. Again, sample size of 1, so just take this with a serious grain of salt. But boy, this year looks a lot like last year, doesn't it? I mean, that is amazing how similar these 2 years were. And again, last year we bottomed into October 27th, right at the lows, 10.1% correction. Everybody said the end of the world was near. Your average, your bottom's on October 27th. So just kind of be aware, again, that we're in that time frame. I've shared this with you, I think, every time, so I've shared it again. Election years, when you have a president, a new president. And I know what's happened with President Biden stepping down, so this kind of maybe has a major asterisk next to it. But you're up the last 10 years, 12.2% on average, and you have a new president. So it's lame duck years where things get a little squirrely. Now, technically, we don't have a lame duck president right now. Our president is not running again. I'm aware with semantics here, but still, just something to think about. Just a couple more big picture things. August 19th, we saw, this is the data from our friends at Ned Davis Research. We had, which one was my share? Oh, this is a 10-day moving average. So we had over 90% of stocks above their 10-day moving average recently, but just less than 2 weeks before is less than 15%. So that buying thrust, everything's oversold, everything's overbought. October 19th was a big deal. You see the returns there. Higher a year later, what is this? 22 out of 24 times. That's not too bad, with some pretty solid returns there. So just, some things to think about. Also, we had a 90-90 day 2 Fridays ago. And again, this is using, I think it's, what's it called? The multi-cap. Oh, no. Okay. Common operating companies only. Again, this takes out preferreds and bond-like proxies, again, from Ned Davis. But again, 90-90. What's that? 90% of the stocks were up. 90% of the volume was up a couple Fridays ago. It is what it is. You see it there. These tend to resolve higher. Sure, a month or two, who knows what's going to happen. Maybe we do see some volatility and pullback or consolidation. But these are big picture things that, again, suggest to us why we're still overweight equities, why we still like industrials, financials. Our biggest overweight all year, I'm talking about this, is mid caps. Quietly, no one's really talking about them. They're doing pretty well. It's just small caps and large caps is like the Yankees and the Red Sox argument. Mid caps just quietly kind of going higher. The Jane Brady group, if you will. We like that. Just a couple more, not on my bingo cards here. On the left, I know this is the F word, fundamentals on a more of a trading show, but we'll just quickly talk about this. CBO did a projection before the pandemic, this is one on the left, of what the economy is going to do. Economy by that, GDP in the U.S. Our economy is growing faster than what the CBO predicted. That's before a 100-year pandemic, before we shut down the economy, and before the most aggressive Fed and generational high in inflation. We're still growing faster than what they expected. That is why we're at all-time highs. And on the right, real incomes. Yes, inflation's higher than anybody wants, so it's coming back. I've come on for a while saying that. And we think inflation is last year's problem. We started saying that in February. Nonetheless, real incomes continue to increase. There are cracks in the consumer. There are more delinquencies out there. Lower incomes are clearly struggling in a lot of cases. But the honest truth is, if you look at the top, 30% or so, a lot of people are employed, still getting good raises. A lot of people are still spending. Maybe you're not spending as much, right? We wouldn't be surprised at all if you start to see some pullback in spending. That doesn't mean you have to have a recession. We think it's more of a mid-cycle slowdown, and those rate cuts are likely coming, and that can kind of continue to help things. Oh, there we go, rate cuts. I shared this before, but we call this more of like two more, I think, with a normalization cut, kind of like 84, 95, and honestly, 2019. People get it. 2019. Things were good. Fed cut a couple times because they hiked a little too much in 2018. The economy wobbled, didn't fall over. You see the returns there. Historically, you're up, good deal after normalization cuts, as if they're cutting before a recession. And I get it. Nobody knows. Are we headed for a recession or not? We continue to think we are not headed for a recession. The consumer is still spending. Just this morning, the employment backdrop, we had that big spike in claims 5-6 weeks ago. Claims are coming back. We're not seeing any layoffs. We saw a jump in hiring last month in the JOLTS. Now, I know there are still some cracks in labor market, but overall, we still do not see a recession. One other cool thing about this, the Dow made a new high on Friday. I took a look since 1900. 6 months later, our economy has been in a recession 9% of the time, 6 months after a new high in the Dow. What in the world does that mean? Well, since 1900, we've been in a recession 22% of the time. And I know there's a lot more recessions earlier in our country's history. But when you look, it's extremely rare to fall into a recession within 6 months after hitting an all-time high. Yes, before COVID had happened. Yes, in 2007 it happened. So those times didn't work. But majority of other times, the best indicator we have for how the economy is doing is the stock market. So let's just kind of remember that. Bull markets last longer. You think this one's almost 2 years old now, from October of 2 years ago. The average one lasts almost 5 years. Who knows how long this will last? We've been saying it for a long time now. Be aware this cycle could go more than you think. Also, your average is the stuff we talk about with advisors and their clients. This is interesting. Your average up year is 19% on the S&P. Okay, so when you're up, any of the up years since 1950, up 19%. Sounds like a really big number. It's actually perfectly normal. But then you're down is 14%. Your average is right around 7 or 8%. So just some big contextual things. The consumer is still strong. This looks at, I don't want to get too into it, but all of the balance sheets, right? There's a lot of debt out there, yes, but there is a lot of assets. There's a lot of equities. People own houses, people own stocks. They've created a lot of wealth. And in a lot of cases, the balance sheets of consumers, it makes people mad when I say it, are in the best shape they've been in 25 years. Okay, because again, it's something we look at there. Last one, I think, I shared this before, but it's from our friends at Bespoke. If you invested $1,000 under Democratic presidents, you have $61,000 right now. $1,000 under only Republican presidents since '53 in Eisenhower. You have $27,000, but took that same 1,000, invested the whole time. $1.7 million. Don't get too worked up about the election when it comes to your investments and politics. All right, I'll stop sharing. I'll take a breath. That was fast. I know. I came out swinging today.
That's like a 6-week course.
He's like the Micro Machine Man. Do you remember the Micro Machine Man? When they talk, micro machines, and do you remember that? Do you remember that, Ryan? When you were little kids, and micro machines, and the micro machine guy, and he talked so fast, and he was telling micro machines.
Yeah, I think I'm moving heads up there, but I mean,
it's so concise.
I made that deck like about 30 minutes ago. I mean, I've got all the stuff.
No way. You made that in 30 minutes. I couldn't make that 30 years.
Well, I created all the data before I threw it together, but nonetheless. So I'll talk a little slower now. Sorry.
But you're unbelievable. Unbelievable. The stat man brings it again. He always brings it, stat man. I'm trying to there's so much to unpackage here, but the thoughts I'm getting from is we might see a little bit of seasonal weakness here in September, but long term, we're probably still going higher. Is that kind of like the summary of how you're feeling right now?
Yeah, it is. And honestly, October maybe too. I mean, we might see some of that.
5-6 weeks. Tom Lee, maybe 7 to 10% pullback, and then get some stocks and get in there because highs at the end of the year. Kind of that's how you're feeling?
No, exactly, Dennis. I mean, we've been overweight equities at the Carson Group since December of 22. We have not changed that. That wasn't always a popular call. People hated that call most of last year, but we're still in that camp. But again, we actually added a 3% allocation to gold in March of 23. Okay, I looked at that kind of like a bond, alternative, if you will. Obviously, gold has done well. Like I said, we've added some low volatility. We're not bearish at all. I want to be clear, but we have been positioning some of we added treasuries about 11 weeks ago, I think. We've been positioning for maybe some volatility. I mean, this is a 2-year-old bull market. I mean, it's aging, so just be aware it's not going to be so straight up like it's been. But that's not the end of the world, and that's probably an opportunity. And yes, we don't see a recession, like I've said before. So we definitely, our biggest overweight has been industrials and financials all year, and small
That's
caps,
Berkshire Hathaway.
overweight, and mid caps have been our biggest bet overweight. So they've done overall okay.
So Ryan, if every time, I mean, not every time, but if when the market sells off like we did on the first day of September, and you have a lot of people worried, and you go out and you look at the data and you see like, well, most of the time we actually end the month higher. Like what would be, I guess, like your signs where you're not cautiously optimistic to where you're like, okay, maybe it's time to get underweight equities? What if the market doesn't react positively to rate cuts and it looks like the economics, there's more of an economic slowdown than we thought? Like, what would be your canary in the coal mine that you're, all right, now's the time to not be overweight anymore?
No, great question there. I mean, I like to keep it simple, right? Look at credit spreads. I mean, credit spreads have continued to show no major stress in the system. So until we see spreads blowing out more, then I'd worry more. And the leadership, I mean, I'm an old school, like probably most people listen to this, John Murphy fan, right? Message of the market. Look at what's leading, what's not leading. If you told me that utilities were the top sector this year, and staples are doing pretty well, and parts of healthcare, defensive things are doing well, I might be worried because we saw that in the fourth quarter of 21. The more defensive things were flat out leading late in 21. We know the wheels fell off in 22. But what we're having now, we do have that now, some of that defensive leadership, but we do have some of the more offensive leadership. I mean, just on Friday, financials and industrials closed at all-time highs. So if we started to see more weakness out of those cyclical areas and more strength out of defensive areas from a big picture point of view, yeah, that would probably worry us a good deal more. And also, I love looking at technicals and technicals and momentum. Advanced decline lines, you see most advanced decline lines at all-time highs over the past week and a half or so. If you start to see deterioration in those advanced decline lines, you start to see not as many sectors participating, those would be the things that would worry us a little bit more, along with credit spreads. And again, Sonu Varghese and our team follows the macro data very, very closely, digs in all the time. And he's been continuing to say that, things are slowing down. Yes, but they're not cracking. I was excited to see the initial claims data that just came out this morning. Again, we saw the jumps in claims, and maybe it was because we had some really bad weather in Texas, about a month or so ago. Maybe it is because seasonally you tend to see spikes in unemployment every single year into early August, and then it rolls back over. So that's those are good signs as well. I mean, you think about fundamentals. I don't follow fundamentals all that closely. I know enough to be dangerous, but initial claims are that one that, hey, that's real-time data every single week, right? If claims are spiking, if stay above, let's say 250 for 3 or 4 weeks in a row, that's a worry. Okay. Well, it's not there. I think we were 227 this morning. I think that's what I saw. So we're not there yet. So those are the things we'll look for in real time.
Got it.
Ryan, before we let you go, I know we kept you for overtime. I got
nothing else going on. Yeah, whatever.
I do have a downgrade.
All right, let's hear it.
I'm not as optimistic about Michigan football this year.
Well,
I'm worried about this game against Texas.
Texas looks good.
Texas is that.
And as you probably are fully aware, Texas's quarterback is an old Ohio State guy, so there's that interesting dichotomy there that just a little more.
I mean, how like the market goes up, and then like it really needs to keep going up. Well, I kind of feel like we hit it, and we're either gonna
win a national championship. You can't really go a lot higher.
Well, aren't they replacing all 5 linemen, offensive linemen? All 5?
And all those guys that went to the NFL, big test. I may be singing a different tune against the Longhorns. I will be there, but I'm not going to be as cocky about Michigan football.
I can't blame you. You lose a bunch of players, especially that line. That line was the best in a long time. But hey, listen, I'm a Bengals fan, right? I'm telling you, a lot of people are saying Lions Bengals Super Bowl. We talked about that last time, so maybe we get to hang out. That obviously those two. I mean, the good thing about the Bengals, we have Joe Burrow who's healthy for a change. but they've got the 4th place schedule. Like their schedule is easy. Last year they had a murderer's row schedule. Now because they got last place because he got hurt, they're in theory, and I know quotations, their schedule's easier for the Bengals. So who knows? We might have a Lions Bengals all cats Super Bowl, which would be pretty cool. Yeah.
All right, man. Ryan Detrick, Carson Group. I mean, unbelievable there. Ryan, I can't thank you enough for coming on for all the years. And I can just tell the chat that like what you put together is not Chat GPT. It's not fake AI. You've been doing this for 100 years. It's amazing the way you put together this information. I can't thank you enough for coming on the show. And we'll dial you up. We'll get you on every month, and we'll keep it that way. Thank you so much, Ryan.
See you in October is what I'm going to say. All right, guys. Take care. Let me know when you'll be back. Thank you. Appreciate it. Yep.
All right, guys, that was Ryan Detrick, of course, the chief market strategist at Carson Group. Always coming with the stats, always coming with the energy early in the morning. We love having Ryan on. All right, couple minutes.
Copy of stats right there.
Yeah, a couple minutes left on the show. Where do we want to go? Dennis, we got to talk some AV.
Yeah, we didn't talk any earnings here today, and there's not a ton of earnings that report.
C3AI,
one stock that I have a fairly significant position in is AeroVironment. I think the story here is still really good as well. Technology, again, I'm just sold on tech is really cool. The stuff they have, obviously, benefiting from the Ukraine situation. AV, talk to me about the earnings.
Yeah, so we had EPS come in at 89 cents, beat the 66 cent estimate. Sales came in at 189.48 million, beat the 184.71 million. So beat on both top and bottom line, but slightly soft guidance for the year came after that. So the stock actually not doing much on that report. Down about 2.5.
It
dipped, but then got bought back. So we got down to around $180. Bought back up to
Dennis. What's the valuation on this?
It's 54 times forward earnings. But one thing to consider here, Joel, is that guidance does not include the new U.S. government contract that they just got last week. Man. So they just signed on that 5-year, $990 million U.S. Army contract. You can say, oh, well, what's $990 million? Doesn't sound that much. Well, their revenue last year was $800 million. So this one contract, again, it's 5 years, but it is a huge contract for them. The Switchblade systems. So that, is not including that. And he was on Mad Money last night, and he's very conservative. Kramer was trying to get him to be more aggressive with the guidance, but they were being very conservative. Just because they said they don't know what the administration's going to change. So they were concerned, they got the 5-year contract, but then you're going forward and get an administration change. Maybe things change. So they were being conservative for reasons. The technology in this company is just unbelievable. It's obviously for warfare drones, but I think they're going to expand, and obviously into other things as well. The drone technology here is incredible.
I know you had the dip. I'll just give one number to AB. You can make your comment. To me, Dennis, I just keep an eye on this 190 level. I know you breached it big time going to almost 175, but I just look, you broke out from 190, you came down, then you broke down through 190, then you came back up into 210. I would like just over the next, not on a daily or weekly, I'd like just to see it form like major support at 190, build a little base, and then take a shot at the all-time high.
It's in my long-term portfolio, and I'm not looking at it.
Good.
Got to stop looking at the long-term portfolio. That's the key to long-term investing. The stats from Ryan. Invest just under Democratic, you had 60 grand worth $1,000 investment. Invest just under Republican, 27,000. Just keep invested, 1.6 million. Let's just stay invested. Long-term, stop looking at the long-term account. Trade, but look at the long-term account. Not every day, not every week. Just kind of know what you got. Good stories, reasonable valuations in the long-term account.
We also had C3AI earnings, which failed to impress investors. Stock down 20%. The EPS beat estimates loss of 5 cents versus the expected loss of 13 cents. Sales also beat, but again, you had some soft guidance there like AV. And as far as AI companies go, this stock has just been a disaster. Never really got it rallied a little bit, but never really
got the ticker symbol, and that's it.
Yeah, it has the ticker symbol, and that's it. If you're looking for AI companies, ironically, AI is not the one for you. Unless you like buying dips and falling knives, and you want to come in and try to find the bottom here on C3AI. But all in all, not great reaction there from C3AI.
I don't know what they even are. And I don't know if they know what they are, but they got the best ticker symbol out there. So that's helped them and helped them to propel the stock, obviously, up to those highs that we saw back in 2023 when it was over $40 a share. It's been leaking since 18, still not profitable. Sales, not great either. I mean, guidance for sales, not great, kind of in line. 2025 revenue, $93 million. I mean, this is Q2 2025, but we're just talking like it's such a small company. Maybe they can find their way, but this is not even on my radar.
All right, guys. Well, that takes us to the end of the show, 9 a.m. Thank you to everyone who tuned in this morning. Thank you to Ryan Detrick for joining us. We'll be back tomorrow. Of course, we've got a lot of economic data coming our way tomorrow.
Big earnings reports tonight, too, just, to let you know. Broadcom, AVGO is going to be the highlight tonight. Full disclosure, I have trading position. Broadcom not going well today. DocuSign is another one that's going to report. I'm looking GWRE, Guidewire, Internet of Things, IoT, which is some Sarah, a few companies, but you're coming out of earnings season now.
Yeah, then tomorrow I mentioned we'll get the U.S. employment report. We'll get hourly wages. We'll get the U.S. unemployment rate, which is actually expected to come down from 4.3% to 4.2%. So kind of a high bar there tomorrow. Who do we got coming on to help us?
Who do we need to interpret economic data? Who's the chief economist of PreMarket Prep?
Blue Putnam.
Yeah, actually, and I got Blue just because it's such an important week and a half of data. I got Blue coming on Friday, and I also have them coming out for the inflation numbers. So a double dose of Blue over the next, I believe, the next 4 shows.
Yeah, I think it's next Wednesday, the 11th.
You got it.
All right, cool. Well, that'll be a wrap on pre-market prep for us today. Please smash the like if you haven't already. We do have live trading starting up right after this, so do not go anywhere. Thank you again to everyone who tuned in. We will see you guys tomorrow morning.
Hey, Triple D, we're going to do the close and print today?
Yes, we are.
And I'm going to ring you at 10, okay?
Sounds good. Okay.
Bye.